raised money, or are raising money, or will be raising money soon. And they haven't done it through a bank. All right, great. So I want those people to ask some questions. You want to get engaged here a little bit. So the first thing we're going to do is we're going to have each of the panel introduce themselves, and I want them to tell me briefly a little bit about the organization they represent, and I want them to talk about themselves and their own professional background for a minute or so that we have a little understanding of where they come from in some context. So we'll start out with Ryan.
Hi everybody, Ryan Weber, one of the founding managing partners for a regional venture fund called Great North Labs. Prior to the fund, I was an entrepreneur for 20 years, ended up bootstrapping a company, 170 employees. There's a number of businesses around digital media. Started off as a consumer business. The last operating business we had was the mobile advertising network, focused on in-game advertising. Traveled a lot around the globe, sold a last operating business to a Chinese company, and spent a long time in Asia the last 10 years. But started the company in St. Cloud. Had some great mentors locally, and we're very fortunate to stumble across at a young age, 19, CEO at a lake home in central Minnesota up in Silicon Valley. Long story short, during this journey with my twin brother Rob, we ended up, I headed product, Rob headed sales, we had a number of different business units, but we started a family office where we began angel investing. I did over 11 years as an investor, as an angel investor, did 25 investments. And also invested in a few of the funds that you probably hear about now in the Twin Cities. We were an LP before we could work on it full time and doing angel investing and involved in a lot of ecosystem work in the Twin Cities as well as, with the advent of the fund, we wanted to, we felt that the region was really heating up, but there was an opportunity to develop an entrepreneur kind of led fund to take our operational experience and our relationships and provide that along with the capital and get our friends from the tech community to support the next high growth startups in the upper Midwest. So we've done, starting the fund, we've done 20 investments so far. First check usually is $100,000 to $1 million pre-seed to seed stage, and then we reserve half of the fund for follow-on. It's a $24 million fund. I had never raised money until this fund, so I can empathize with everyone here that raised their hand. We've been with the company. 10 years in, we started office in Twin Cities and in San Francisco. Built a lot of relationships there, and excited to work with many entrepreneurs and hopefully develop the next high growth companies and support them.
Thanks.
Hi, I'm Kay Christensen. I'm a member of the local chapter, our Golden Triangle Angel Investing Fund. I myself was an outside salesperson. I sold advertising for an industrial magazine for 30 years. So I have traveled and flown and mostly driven everywhere to small to large manufacturing companies. It always fascinated me how some companies could make the identical product and yet some were way more successful than others. So I guess I always thought of that as interesting. And then once I retired, I was invited by Neela to join the group, and I have not been a business owner, so I've really been learning a lot, and my desire is to, we personally picked Red Wing to live in, and I feel that it's important to invest in the community, and it's not a charity. We're in it to make money, but it's the best ideas and how we can help those people to make their product come to fruition. So it's an honor and fascinating to work with a lot of different variety of ideas and help in a financial way. And as like I said, a salesperson selling the product, it makes me very jealous sometimes to see maybe if I had done things differently, I could have done a company of my own and pitched it. So now's my chance to help some others.
Hi. Xavier Frigola from Rochester. I'm part of an organization called Rochester Area Economic Development. I'm the manager of two investment funds that we have there. One is a public seed investment fund that we use to write normally first, second checks of the round where outside investors come in. And the purpose of that fund is normally to anchor those companies in the region and basically set them for growth there. And the average size of that fund is about $50,000 to $150,000. A lot of it is technology. Since we're in Rochester, home with Mayo Clinic, there's a lot of medical devices, healthcare IT, biopharma, and things like that. So those are businesses that are going to need a ton more money, but not only the first outside check or the first outside commitment to those ventures. Then in 2017, we raised a private angel fund. It became a $2 million fund, and of that, we make $100,000 flat investments. Normally follow on the first public fund type of deals that were highly successful. And between the two funds, we end up making 6 to 8 deals a year, normally a little over $1 million combined. And we hope to raise another fund now in 2020, 2021. It probably won't be in that $24 million, but I think that we could raise another 5, 7.5 type of thing for our second fund. My background is I'm a scientist, former scientist by training. I'm an immunologist that through a winding path of life has found itself running a business incubator and seed investing. It's a fun path though. I think that's what I want to say.
Diane?
Hi, I'm Diane Lewis. I work for Southern Minnesota Initiative Foundation. We are a nonprofit organization started probably like around 30 years ago by the McKnight Foundation. We cover 20 counties in southeast and south central Minnesota. We have 3 initiatives. One's community development. We work with early childhood. And then we have the entrepreneurship, and that's the area that I've been working with for 19 years. My background has been working in the lending area for probably 30 plus years. Yes, I'm ready for retirement, but the thing is when you really love what you do, and I love working with entrepreneurs, this is going to be the hardest decision that I ever make, but I'm still here. So going back into the entrepreneur arena for the foundation is we have a lot of lending initiatives going on. We have an SBA microloan program. We have gap financing up to $200,000, and then we've always had a seed fund. So the seed fund is it's the idea stage. So if you're just thinking of something that you want to invent, that's where we would come in with a small amount, and you could then do a prototype, get some working capital dollars, and we give you the dollars. It's up to $25,000, and we give you the dollars up to a year, no interest, 0% interest, just to get your business up and running. So then we've had that for years, and so a few years ago we did a study in the region and found out that more dollars were needed beyond the initial. Once you get your prototype, you're not be able to get a bank loan probably. So the study showed that we needed to have some investment dollars. So just a few years ago now, we also started an investment up to $100,000 with Xavier's group in the Southeast Minnesota Capital Fund. We partner a lot with him, and obviously, because of the region that we're in, a lot of our investments too are in the medical field, but we take a look at any investment idea that you have.
Great. So, quick follow-up question. So, you're doing, in that fund, that seed fund, you're doing about 100,000, and yours is about 150? And you kind of jointly do these together, some of them. So, between the two of you, it sounds like you might do, if you scrub away the duplications, you're probably doing about 4 or 5 deals a year that are not duplicates. So you might do 6 investments, but 4 of them you're co-investing in. Is that about right? About that? So how many deals a year do you look at to get to those 6 or 4 or whatever?
Around, so it was 100 in 2018 and a little bit over 80 in 2019.
Okay, so it's less than 10%. Yep. Okay. How about Golden Triangle?
We've actually invested in 4 different companies over about 2 years.
Yep. And then, do you know about the total amount invested?
About 4 70, or is it?
That's pretty close.
Yeah.
So, but your fund works a little different because the way their fund works is the fund puts in money, but members will put money alongside it. So
Right.
the overall is about 100,000. But what you're doing is about 150, and they're doing almost that much. Okay, but you're the bigger fund in the block.
Yeah,
So you go from 50 to $1 million. Okay.
we've been trending to about 350 for initial bite size.
Yeah, okay.
We were investing a little bit smaller bite size, because we were still fundraising. We didn't know we were going to raise. We were only going to raise 10 million originally.
Yep.
But with that, there's a lot of opportunities in the region. I do think it's undercapitalized. We've had 18 months in. I haven't pulled the numbers lately, but that was as of last summer. Our first 16 investments. We did diligence on about 180 companies.
Okay.
Where we actually we did a meeting. We did hour prep, hour post, all the way through. Almost sometimes we get all the way close to the finish line. And something the deal falls apart. We've had occasionally investors, they started pulls back, but we had about 1,200 solicitations in our first 18 months.
Yeah.
A lot of funds sharing deal flow, but the Twin. There's actually there's some data. The Twin Cities was ranked, in the by PitchBook as the number a couple months ago came out was most relative to scarcity of capital and the quality of investment opportunities is really the number one market to be a venture capitalist. And that's what we can, we're really, we're doing, I'm based in St. Cloud, so I started a company, and we're a regional fund. But there is a lot of momentum, and as a result, there's a lot of money looking to get into this region now. We're seeing a lot of interest from other funds, and so we think we'll bring 10 times the amount of capital into the seed and Series A round that we deploy as a result.
Okay. So tell me, describe the kind of the ideal candidate for your fund in terms of industry or technology focus, sort of the stage that they're at, and maybe the amount of capital they might need under that round. We'll start with you. We'll go that way.
So initially, we have there's different stages in a startup. As our partnership has experience going from the very beginning, the idea stage, all the way through multiple IPOs as a partnership. And so as you can imagine, at each stage, you have to pass certain thresholds. We look at the market. We want to see big markets. This is common in venture capital. We like to see big TAMs, but also an addressable market, like a bottoms-up analysis, where we think we reasonably get to tens of millions of revenue, like gross profit revenue by year 5. And then we look. The market is usually the first thing we analyze. It's kind of the easiest one to kind of quickly assess is this is big enough market. The other, we look at the team. We look at we think the best opportunities right now is with tech, but tech-enabled services. We've done a lot of software applications, web software. It's been like 80%. We've done a couple IoT with software, also robotics investment. One of our first 20. We have a pretty diverse set of experiences. We're diverse in the industry. There are certainly some themes that are emerging. We're seeing a lot of property tech right now. Done a couple in healthcare. But we're all over the board. We have experience with consumer enterprise. Most of the investors in the Twin Cities and in the region are focusing on enterprise software businesses. But for the stage, for pre-seed, you need to have a strong thesis, and your thesis needs to be validated, with qualitative and quantitative research. You don't even have to build the product, but if you can articulate the opportunity and you validate that this is the solution that needs to be built, done the work, the research, we will fund you, and we invest earlier in startups that are underserved or underrepresented markets. So we reserve 8% of our fund to do the pre-seed investing, and so you don't even have to have launch. Most funds aren't investing that early. Our challenge is deploying $24 million, 100,000 or 200,000 at a time isn't really scalable. So that's why we chose to service underrepresented, underserved founders. And so looking for deals in greater Minnesota in smaller markets, that's one of the groups we're focused on. So in that stage, I meet a lot of, as an angel investor for 10 years, I met a lot of the top startups coming out of the Twin Cities and in the colleges, and compared to Silicon Valley, where they're like lean startups, was very popular, kind of common practice. I couldn't hire product managers that were really disciplined in how they were applying, thinking through their idea and validating it. And so we built up a practice internally from, there's a very strong classical product management heritage and history of entrepreneurship, but there's an adaptive style that came out of tech that's now become very popular. We work with, Eric Reese was a business partner of ours at Imbu. We were following this stuff really early. He wrote about it in the Lean Startup. So we were early practitioners, but when we started the fund, we started offering workshops on this. And that was kind of the predecessor to this new initiative that we partnered with Reading and Guided IoT on. But I think with that, if you can take that class, we have a common vocabulary. And so when I've had 200 participants go through my earlier workshops, when we start talking about what we're looking for and we're on the same page, we talk about what the milestones are, and it becomes a lot easier, to write those checks, because we're doing the same thing. But we've got to get more people working on these kind of projects. I think there's more capital than ever in the Midwest. I don't think you even have to go to the coast to raise a lot of money right now. But I think you do have to. You still have to clear the market if you want to raise from, there are a lot of people competing for it. There is money out there.
So one of the things I hear you say, which I think is really important, is that if you're an entrepreneur, what you talked about is getting on the same vocabulary. Yeah. So there's a certain amount of understanding that you gotta go out and get as an entrepreneur, so that when you're talking to the other side of the table that has the money, you kind of understand their language, really. And one of the things that I think that you said that's important goes actually back to, is it Nick that talked about the course, and maybe you started this course, but this customer-driven innovation, which is kind of what I hear you talking about, which is, at the end of the day, who are the customers and why are they going to buy this thing, and being able to articulate that part of your plan or your idea, right? Because that's what investors really want to finance. So Kay, you came into this from the sales perspective. So tell me, when you see a deal that gets you excited, what is it about that deal that excites you? What's the difference between what you see and you go, I don't really like that, versus when you go, that's really interesting. Tell us a little bit about emotionally what connects with you on that.
Well, I think not just myself, but the fact that we are a group of 18 in our community. So we come from a very variety of different backgrounds. And sometimes there will be things that we get pitched that someone will have a very personal connection to. We had a menopause product pitched to us, not that I'm old enough, but many of the people were very excited about it. There was one for a foot problem, so people got excited about it. So there is that personal connection. And so sometimes you really see something that you've used in your life, and that's kind of the Peter Lynch principle, right? About what you can relate to. And so we're a little different, that we're not running computer models and things like that, but we kind of use a group consensus to say, okay, yeah, we got excited about it, but realistically, would there be other competitors that could easily take this over? Is this person not going to have the funding to make it happen in the time frame that they need to? And I actually think that's kind of a good thing, is sometimes we don't invest, but it's better for the person to know early on that this might not be a viable product to be wasting your life and money on. And we also have then resources to refer them to that aren't always, I know that's another question later, but monetarily, like we might be able to say, hey, look at this class that you could be doing right here in Red Wing. Or we've had people in the trucking industry on our committee, and someone invented a product that would have been helpful, and they were able to get immediate connections.
So we have some entrepreneurs in the room that said they're raising money. Do you have some questions? So go ahead.
Okay, what kind of rate of return are you typically looking for, or what kind of equity stake?
Who wants to take that one?
Yeah, I mean, I think, I can tell you, like, the data right now, in private equity right now, venture investors, if you want to continue to raise funds, you have to hit a median of 15% net IRR, net of fees. If you want to be in the top quartile, you got to hit 25%. My brother and his angel investors, and we missed on a few deals, but we hit a 26% IRR. and we passed on Sports Engine at sub $4 million, but introduced them to angels that did very well. So you learn from what you invest in and don't invest in. But one of the things that really has changed is we've evolved from operating and investing is defensibility, and also as the industry kind of its core or some important asset becomes digitized, there's business model patterns, and they happen in different and you see the same thing almost repeated. And you start looking at it, hearing enough pitches, and you invest in a company. So there's a lot of pattern matching that happen. But I think for the returns, we're a small fund, and so we like to invest in companies that can get kind of default alive as a buzzword in Silicon Valley. And it's like we like to invest in companies that can kind of quickly get to a stage where they can keep the lights on, and can then raise money out of a position of strength. So we don't do real heavy cap. We won't invest. Our funds is an equity based kind of play. There's other funding opportunities for the CapEx side. You can take on debt and so forth, but we're looking for, as an equity-based investor, capital efficient investor.
How about your funds?
Our goal is a little different because we're a nonprofit. We cover the 20 counties. So we're looking at more having a regional impact in the region and job creation. So as your business would grow, we're hoping that with our investment then that you will stay in our 20 counties and not move like up to the metro, which obviously some of them do. But that's our goal, is more to have the business stay in our area. And we're looking at more of a 3 to 5 year exit strategies. So with the dollars then that we get back, then that we can invest in another business that will help our region.
How about your fund?
Well, we're an angel fund in which members invest, let's say, 80% for the thrill of it and return of the money, 20% to build a better community. We've also invested in medical companies, which has a much longer return life. So companies we invest could easily not have an exit in 7 years or so. So that's a long way to say that we don't promise returns. I'm hoping to achieve something in the higher teens, but we'll probably have to raise a second fund with only having on-paper returns and not having real returns.
Does that get to your question?
For the most part, like how much would capital cost to use one of these funds?
So I'll just do a quick answer so we go to that question. So you're asking really how much you got to give up to your company to get the capital?
Basically, yes.
Yeah, and it's a negotiation. So it's going to be based on how the investors view your company and what value they place in your company, and so you're going to haggle over that value. I like to say it's a little bit like going to the market bazaar and you haggle over a rug. It's the same kind of thing. You're going to say, I'm worth $10 million, and they're going to say you're worth $2 million, and then you're going to try to come to an agreement. That's how they're going to price.
There's a new instrument that there is some of that for sure, but there's two standard structures. There's a safe agreement, which you basically, the standard, basically you're not agreeing on what the valuation is today. You're saying at the next price round, there'll be a valuation. There's usually a discount rate for the people that invested early, but they will get the lesser of the valuation, subtract the minus the discount rate at the next round, or a cap. So if your company goes to 50 million and you have $4 million cap, they get shares as if it converted at the 4 million, if that makes sense. So that's a very common way in the pre-seed stage. That's how most deals we're doing are getting done. The other is the NVCA, National Venture Capital Association, for preferred equity. That's for a price round. That's the other common agreement. That's where you're agreeing on the price. It's really hard to agree in the early stages. There's no traditional valuation methodology that holds up. So there's kind of a different things that are expected at different stages, but usually you're negotiating over a capped discount rate and interest rate, also another economic.
And I would say that if both sides want to get a deal done, they'll figure out the right way to get it done. You have a question, Susan?
It was all about that valuation thing, which I think is one of the toughest things for entrepreneurs.
Go ahead.
Yeah, well, I've been on the investor side, more private equity than I'm an entrepreneur. I've raised capital a number of times, and that's what I was just going to get into. It's from my standpoint, when I'm raising capital, it's who you're raising it from, right? How do you guys go through, because I've raised capital where I took the lower valuation because I knew these investors were gonna add value to me. Connections, they're gonna sit on the board and help drive this sucker. You don't just wanna get the money that gives, in my opinion, always the best valuation, because sometimes they're doing that to play the game to get the deal. How do you guys play that game where you're selling yourself is helping to be leadership of the company, right? So
Definitely. I
So
mean,
how do you-
honestly, I see, we're about 35, about a third of our entrepreneurs are on their second or third, startup that have past exits. They can choose who they want to raise money from. And they tend to not optimize for the economics as much as they optimize for who they're bringing on. It's honestly, it happened, I mean, whether they're right or wrong, that's what I see. First-time entrepreneurs are very much seem to optimize more for the valuation and the economics of the deal. But I personally think, I think you want to get a reasonable market rate, but I do think, the top tier funds usually have, their choice. And if you're a first-time entrepreneur, you'll be lucky. I guess you just have to weigh that in. And also you have to be clear, what are you trying to get from a fund? Because there's industry-based funds, there's regional funds. They're all going to bring you something different, but you should, I think it's always a dating ritual, get to know the investors before you take their money, because you're going to be in it for 10 years probably.
And even before you get to that stage, there are some well-known angels and angel roads here that kind of like set you to that track. Like for instance, for us, if the Gopher Angel has invested in a prior round and they're going to invest again, that sends a positive signal. They see hundreds of deals a year and they chose that one. So for me, that's a good signal.
Time for one more question? Anyone out there?
I was just, for entrepreneurs, because I'm an older entrepreneur, so I've been through the game a little bit. But that's where, how do you tell an entrepreneur to come in and say, I'm worth $1 billion? Because everybody feels they're worth $1 billion, and that's a great feeling to say, I got the next big idea. But sometimes that can be a problem when you're pitching for money because you're overshooting the net there a little bit, and it can make investors nervous. So what would you tell people that are looking to get their valuation but not make it a situation where you're thinking they're a little off base?
I tell them.
If someone's looking to raise money, you do that so they don't do that to you. So what would you tell somebody that said, how would you, when you go ask for money, what do you want to hear? You want to hear,
As I
here's
said
my
in the conversation, I ask them, what are your terms? And if they say it's $50 million, but I don't have a prototype.
No, I know, yeah.
What I'm seeing at these evaluations and development stages is more in the range between this and that. And they normally screen if the evaluation is 10x difference from what we've won and what they won. But they may do the rounds and just decide that no one's investing at that valuation.
Yeah.
I think if you can find a trusted advisor, and maybe you probably will get people that do this for a living can probably tell you a range. You can decide whether you want to hear it or not. But like there's enough investment opportunities, like you can kind of they'll give you some benchmarks because we see a lot of deals. I think the other thing, there's a strategy about going about fundraising. Before you're negotiating the economics, you need to get people interested. If you go out there and say you're going to raise let's say you say I'm going to raise $5 million, and you're fundraising for 6 months and you don't have $1 million yet, you just got a bunch of no's. And when you start, there's a psychology about fundraising. You need to get people saying yes, and take you seriously. And so they coach us in the top accelerators. But you want to get multiple funds. If you want to drive the valuation, the best thing to do is get multiple funds competing and create a scarcity and have your selection amongst multiple great funds. And if you start with with your friends and family and your insiders, you've got a third of it closed. You go out there, maybe you want to raise $5 million. We say, we got $1 million, and we're thinking we're going to raise another $1 million. But you want $3 million. You go out there and that $1 million fills up, and then real fast, and all of a sudden everyone starts throwing money at you. Now you can decide, if you want to go after the full 3. But I've seen this. I'm going through this right now with the founder. Their valuation problem. I thought they would clear market and get $30 million valuation. It looks like it's going to be $8 million pre-money. They went out trying to raise too much money, too aggressively, turned off everybody, now they're like running out of capital, they have 1 month left, and they're desperate. You know, so you gotta be very, I think if you work with someone who's done this, they can help you, coach you through this, but it is a negotiation, it is a process.
Something I wanted to add to that too is raising money from venture capitalists. It's always good to have those relationships. So you're meeting regularly, you know, you're keeping them updated on what's going on. You say, do you think I should raise money right now? You get their input, because when you find the right match, the venture capitalists will say, yeah, I want to invest in your company. That's really, let's bring partners in and talk about it. But if you go in and hard pitch people, like you said, it can go one way or the other. Most of the time it fails.
I can say one other thing is that for entrepreneurs too, if someone's really ready to write you the check that you need, think long and hard before you walk away from it, because you'll end up like that group where they didn't take the money when they had a chance, and then they're starving for money and they can't raise money, and then the value goes down and down and down. And so a lot of times when you have to kind of choke on the value you're going to take, it's better for you in the long run, and it preserves value in the long run. And people forget about that. They look, oh geez, you know, I thought it was worth 10 million, I'm only going to get 2 million, but you know, it might be worth 20 million down the road 10 years because you took that money. So any other questions before we?
One last point, the number one rule of startups is don't run out of money. CEO, never run out of money.
Personal plug, my son has made a shirt that says, do shit, be great. So, if you want to take any orders, I can do that.
Thank you very much. Go ahead.
I have some brochures over at that table over there. This talks about our seed fund, our equity fund, but also our loan programs that we have available too. So there's some brochures over there.
One more plug, we're hosting an event August 27th. It's for Greater Minnesota, big theme, startup ecosystem across Greater Minnesota. We'll be bringing communities from around the state to St. Cloud. We had 300 people at our first one. Neela and I joined a panel on Greater Minnesota entrepreneurship. That's how we first met. But we're expecting 500 people this year. There'll be venture capitalists coming from around the Midwest, but it's open to everybody. We're going to fill up the room and make people drive up from the Twin Cities. I know it's a little farther for you. Maybe we'll give you maybe valet service if you come up. Great North Lab's website, you can sign up for our newsletter. We send it out monthly. We'll put out information soon. But August 27th, it'll be during the day. Generator, they'll be doing their G-Beta program for Greater Minnesota. Their pitch at night too. So if you want to stick around, you can hear the pitches as well.
Okay.